You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell securities or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out www.optionseducation.org. Now, here's your host, OIC's Director of Retail Education, Ed Modla.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining me today on Strategy Spotlight is Dan Gramza, the president of Gramza Capital Management. Dan is a longtime friend and working associate of the Options Industry Council who travels the globe giving educational presentations in addition to running his own business. Dan, I know you've got a long storied history and background from a personal and professional perspective. So let's start there. Can you tell our audience a bit about your experience in the industry, what took you to your current role with Gramza Capital Management, and what you're up to these days?
Well, okay, we'll get started there. My first area of interest was stock options, and that's where I began my financial career, was studying stock options. And what fascinated me was I felt that the financial markets is a quick way to take capital and invest it in other forms of capital, and it makes it a very liquid inventory. So I knew with stock options I could easily get in and out. I didn't have to worry about someone buying my product because I was involved with companies that did do that, took capital, made stuff, and then hoped people would buy that stuff. Well, when it comes to stock options, I thought it would give me that opportunity. And I was primarily focusing on delta neutral spreads, but I realized that I eliminated my sensitivity to price, but I got a new friend, and that's volatility. So I thought I'd go back and study price. And at the time, the the people that I knew at the SIBO, no one was really focusing on price, because as a market maker, you focus on how to manage the Greeks to really manage a position, because market makers inherit positions oftentimes. So I thought I should look at price, and the guys across the street over at the Board of Trade, they looked at price, these futures traders. So I actually got a Chicago rice and cotton exchange seat and went to the floor there to look at how that market functioned. That gave me the background to look at price in terms of order flow coming into a market. And then I had the opportunity to teach a course on market profile at Bank of America in Tokyo. And during that class, part of it was to trade the yield curve. So I went into the dealing room, found some trades in 30-year treasuries. I'm walking back. I see a fellow drawing these charts, and these candle charts, actually. And I asked Kuno-san, the fellow I was with, I said, what are these things? And he said, oh, these are Japanese candle charts. What was helpful for me at that moment, when they were kind enough to talk to me, is that it was a representation of what I saw on the floor. So my interest in technical approaches to trading kind of blossomed from that awakening, in a sense, for me. I thought I could now look at a market and see its representation on a screen, not necessarily to be on the floor. And so through a word-of-mouth network, and it started with the CME, I was asked to teach some courses for floor traders, and they opened it to the public. And a couple fellows from RBC out of Toronto came. They went back. They're doing a little better. And as you know, everyone kind of knows everyone in a particular industry. And they told some people in London, called Dan, and then from there, it was 35 different countries and over 450 institutions. I just came back from Peru a couple weeks ago and heading over to Amsterdam in a few weeks and down to Australia. But it's all been a word-of-mouth network, and it's been primarily institutional because that's kind of where my name was passed around. Although I do have an opportunity to make some presentations at conferences and in the States as well as other countries like Australia, Italy. So that's how I kind of evolved into what I'm doing. I've also been involved in the creation of ETFs. We created a currency ETF product that's traded by Wisdom Tree. And currently we've gotten, I'm saying we because I have some partners, 3 issued patents on the securitization of diamonds. So we're working on some product lines for that. It's been an amazing process for me. I really feel blessed with the opportunity to travel the world and also focus on trading the markets. So it's been wonderful, and I'm very grateful for it. And I'm really excited about having a chance today to explore some ideas with you, Ed, and also with the audience.
Yeah, well, sure, that's great. It's an excellent story, and it was interesting to hear you speak about networking and word of mouth and how that has affected your career for someone with a strong reputation like I know you have, being great at what you do. It's great to hear that it's worked out that way for you. You mentioned technical analysis during your description, and I want to pick that out for just a second. It's not often that I get to tie in that market analysis with the strategy. So before we get to options, maybe we'll go to the definition of technical analysis. From your perspective, how would you define that? And then what would you say are a few examples of the types of technical studies that you use?
Well, that's a real good question, actually. And from my point of view, the way I would define technical analysis, it is a tool that follows how the market absorbs information. When we hear about economic reports, when we hear about earnings coming out, what is the reference that we can use to see how the market's reacting to that information? Well, one, we can just look at price. We can see a change in the price of options or the underlying that could give us some clues. technical analysis gives us a picture of how that market's absorbing information. And I break it down into three categories. The first category are price displays. These are different methods of recording price movements. So a line chart, bar chart, candle chart, point and figure chart, market profile. These are all tools that record how price is absorbing this information. The second category would be a direct analysis of price displays, and that's where we'd look for price patterns and trends contained within this price information, whether it's candle charts or some other technique. The third category I call an indirect analysis of price displays, and this is where we would use a mathematical study or formula to analyze the price movement. And I say indirect because if we look at a mathematical study, if we break that down, there are two categories. One would be price overlay studies, and these are mathematical studies that are placed on top of price, and that's why they're called price overlay. So moving averages, Bollinger Bands, for example, would be price overlay studies. Then there are oscillator studies, which measure the stretchiness of a market. And in those categories, you would have RSI, stochastics, MACD, those types of studies. And they're indirect because based upon this mathematical relationship, it says something about price action. It says when these two moving averages cross over, it implies a buying opportunity. So we're indirectly creating and identifying an opportunity in price using this mathematical study. So I think those are the categories I think about when it comes to technical approaches.
It really helps to get that definition. I like the way you started out by saying technical analysis really paints a picture for you to analyze. Now we can take that and put together a strategy. First, Dan, I know you've got a long history in the industry, and one thing we often say here at the Options Industry Council is that if you're going to use options, you have to understand them, put in the time, get the education, and use them properly. In your experience, are there any common errors that you witness or even lessons you've learned from yourself in your own trading experience that you can pass along to our listeners?
Sure. I think there's a few areas, I guess, Ed, that I think get abused. Options to me are probably the most beautiful financial tool we have to work with. They're so flexible. They allow us to create strategies and to identify how they're going to function. And we can think about it in terms of what is my maximum loss, what is my maximum profit. It gives us parameters that we really don't have with other tools. So I think it's wonderful. And because it's so flexible, I think it also gets abused. And the areas that I think where it can get abused is like what we're going to be talking about today, a directional position. But sometimes people create a directional strategy or bias, but they don't have a directional reason to do it. In other words, that's what we're going to be talking about today, is how do we incorporate that action, this bias that we have about direction, into an option strategy. I also think out-of-the-money options get abused. People buy an option with the delta of 10, and they say the underlying market moved up, but gosh, this option hardly moved. And it shouldn't, because it's got a delta of 10. It's going to have a fairly significant move to see that option react to it. The other part of that is when people have too tight of an expiration. They buy an option, especially within those last 3 weeks before expiration, where we see theta or time decay is really perking up. So their expectations are beyond what the option is going to deliver. They're asking something from the option that the option can't give. And I think sometimes the out-of-the-money options, the tight expirations, buying options with high implied volatility, which means they're going to be expensive. And then I think the last one is overstaying a non-performing trade. Like, it bothers me when someone says, well, I'm just going to hold on to that option. Who knows? Maybe it will move. And to me, what I'm hearing, or if they'll say, it only cost me $500. And what's troubling for me is they're saying to me, I'm in a trade that's not working, but I'm going to hang in here and just make a $500 donation to the market. That's how it feels to me. And I think there's remedies for some of those issues, and some of which, we can talk about today as we go through strategies that we're going to be looking at.
Yeah, that's a great description, not just of the pitfalls as you outlined in various formats, but also just the description of options in general. You described them as a beautiful, flexible tool. I think I'll be stealing that description during my talks at some point. So now we've got a foundation. We've got the technical analysis that we're looking at. You gave us some examples there, some things to avoid. Let's get into the option side of things now that we understand the approach. Can you pick out a specific strategy and walk us through it, starting with what type of analysis leads you to it, and then putting that strategy together?
Okay. Well, let's start then with the directional bias. What is it that creates our feeling that this market may be moving in a certain direction? It could be the fundamentals that we're reading about a stock that looks good long term. And when I say that long term, one of the important characteristics, I think, of establishing option strategy is, what is your time horizon? Is this going to happen in the next 2 days, next 3 weeks, next 2 months? I think it's important to start there. But we have this bullish bias, fundamentally, let's say. Now, we can also add in here the technical side. And where I think the technical side can help us as a tool is it gives us a guideline in terms of when. In other words, if you and I have evaluated the stock and we say, I'm bullish on this stock because the fundamentals look so good for this particular company or index or whatever it is we're looking at. The issue now then is, when do we do this trade? And how do we do this trade? Do we just buy the underlying now because we reached that conclusion? Even though the market's going down today, is this the best time to buy it? So I think technical approaches can come in here to help us with the when. So for me, one of the tools I like to use is our what I call behavioral Japanese candle charts. This is not the standard approach to Japanese candles, which I've been using since the mid-'80s. It's a refinement of that idea. So if we see evidence that buyers are now coming into the market by looking at candle setups, then let's consider putting this trade on. Or it could be, let's go back to what I used before, 2 moving averages are now crossing over. And those 2 moving averages crossing over implies a buying opportunity. So now that becomes the when. Now we decide to initiate a trade based upon these 2 moving averages crossing over. So it's given us that parameter. The next issue then is, what strategy? What should we look at to capture this price movement, right? So what would be, and that would be the next step that we'd want to look at. So technical tools provide us, I think, with that guideline of when we might want to consider doing something. The
certainly is.
Oh, go ahead.
Yes, I was going to say, it certainly isn't the first time I've heard that description preceding the option strategy of using fundamentals to get that directional perspective, and then drilling down deeper using technicals to fine-tune the strategy selection. So go ahead, Dan, and keep going with that.
Okay, well, you just made me think of something, Ed, and that is this. Let's flush out the technical side before we get into the option strategy. And, excuse me, what we want to think about from the technical side, if you and I were going to take 2 moving averages and said, okay, when these 2 cross over it's a bullish signal. We're now going to initiate a long option strategy. And we have a lot of choices to do that, which, again, is a wonderful part of trading options. Now, but before we do that, I would have some questions that I would want answered. And this requires doing some research for you and I to do some homework. So now we'd say when these two moving averages have crossed over to create a buy signal, let's ask some questions about it. How often has that happened in the past for this particular stock? And when it's happened, how long did it take before the market started to move in that direction? What happened when it didn't work? Because what we both know is not all strategies, no matter what they are 100%. If they work even 95% of the time, it means 5% of the time they fail. So I think when they fail, they teach us. So we could go back, take these two moving averages and say, okay, how many times has this happened? If we get that signal, if it works, when does it work? Does it work immediately, the next period, the next candle it takes off? Now I'm talking about now looking at a daily chart. We find the moving average, crossover signals. We say, oh, look at this. It did move fairly quickly within those 2 to 5 days. The other question would be then how far? How far did it move before we had the opposite signal, before you have an exit signal, whatever that criteria is? Maybe it's two moving averages again. So now we have an idea of what it looks like when it performs. We have an idea of how long that trade takes. So in other words, that tells me something about my patience level. Oftentimes we hear people say, well, I bought this call, and this market was moving my direction, but it didn't start out right away in my favor, so I became impatient and I just got out of it. And then it goes off in my direction. Well, we need to know how much time we need to allow that trade to work, but yet not overstay our welcome. So by answering that question of when it moved, how far it moved, how long it lasted in terms of a trade, now it gives me an idea of what option strategy should you and I wrap around this idea. The other part I'd want to know is what is my risk, just based upon price. So when this moving average signal occurs, does it ever trade against me during the life of the trade? If it does, that is the amount of risk I'm going to have to take if I'm going to sit through that based on price. And as you know, Ed, the beautiful part of options is I can limit that risk right out of the get-go with my strategy. So I think those are some of the things I'd want to begin with when it comes to the technical side of this, because it allows you and I to back into the type of strategy that we want to use to capture that price movement.
Well, yeah, you're right. Certainly the technicals can help draw down into those specifics, and the options product itself, as you said at the end, can fine-tune the strategy and the position to fit exactly what your risk profile should be. So let's get there, including more on the option side with the strategy. Can you walk through maybe a strategy, its risk profile, and then some details on opening, maintaining, and closing the position, along with what you're looking for in options trades? Usually might require some maintenance along the way. That maintenance might just be getting out, as you pointed out a few times. Can you just walk us through how that might look from a management perspective?
Sure. Let's say that we now have done our homework. We have done our research. We have an idea of how this market behaves using this technical guideline for entry and exit. And we've determined that this market will move so much within a certain period of time. One of the tools that we could use on the option side would be, and let's say it's bullish, it's positive. We're looking for an upward movement in price. Now we could use, a bull vertical spread. And that is a tool that has a very specific movement that it's going to take for it to be profitable for us. And we'd also want to look at going back to our research, how long did it take for us to have a profitable trade, and does it fit the time or the price movement that we're looking here? In other words, I shouldn't be looking for a 50-cent move if this market, or a $5 move, if this market really has a tendency to move $1. But I want $5. And what we both know, what I want is irrelevant. Our job is to find the opportunity that the market's giving us. So if we did a vertical spread, let's say that we look at a market that has a current price of 95.61. And we look at a vertical spread, and we're going to buy a 95.50 call at 23 cents, and we're going to sell a 96 call at 8 cents. In fact, if you're listening to this and you got a piece of paper, you might want to write down a few numbers so you and I can look at them together. So what we have is a bull call vertical spread. Current market 95.61. We're looking at buying an in-the-money option, the 95.50 call at 23 cents. We're going to sell a 96 call at 8 cents. So a net debit of 15 cents, right? The difference between what I'm paying and what I'm receiving back in terms of premium. So now we have a vertical spread. Now there's a few things you and I know immediately, is that we're buying in-the-money call, and we're selling an out-of-the-money call. So that we know, let me give you a couple other numbers. Let's add this in here too. That's delta. Let's say the 95.50 call has a delta of 56, and the 96 call has a delta of 22. So what we know there, that difference between those options, right? We're going to buy the call, the 95.50, we're selling the 96. That difference is 33 points here for delta. So and it's positive, right? So the call that we sell has a negative delta, the call we're buying has a positive delta, and we have a net 33. So therefore, we have a bullish bias to that strategy. That's what it's telling us. Now, let's look at a couple other parameters, and let's look at the maximum profit. Now, the way we would get that is we take the difference in strikes, which is 50 cents, minus the net debit, what we had to pay for this, which was 15 cents. So the net maximum profit is 35 cents. And let's talk about maximum loss. The maximum loss would be the net debit, which is 15 cents. And then our break even. How far does this stock have to move before you and I start making money? And then is that reasonable? Going back to our technical research, we could say, typically this market moves within this period of time, and we have a high probability of moving this amount. But let's figure out our break-even level. It's the most expensive strike, which in this case would be the in-the-money strike at 95.50. And then we add the debit to it, which is 15 cents. So this stock has to move 95.50 plus 15 to 95.65 for us to break even. And again, I would look back at that technical approach. Is this reasonable? Can we move at least 15 cents in the period of study that we're looking at? And if we can, this may be interesting to look at with this tool of a vertical spread. So now, that's the beauty of options. We can figure out a maximum profit, the maximum loss, and the break-even level, which, it's just fantastic. And then we decide the when. So now we're going to use this technical approach to help us make that decision of when to put this on. I don't want to overstay my welcome. I want to get paid for the trade. And one of the things we can look at by doing this little bit of research on these technical ideas is when do we get paid typically. So I'm looking for the trade, let's say, that takes off within 5 days. Now, if it doesn't, I'm changing my strategy, right? If you and I started out and said, I think this market's bullish fundamentally, let's look at when we can do it. We do some research on the technical side, and we say, okay, right now we should put the trade on. Based on our research, it should move within 5 days. So that's what you and I agree on. And it's more than 5 days later, and I'm still in the trade. Excuse me. So at that point, I just changed the strategy. I'm no longer following what I said to you. Excuse me. I'm no longer following that, right? If my strategy said 5 days and I'm in there 6, 7, 8 days, well, I'm overstaying my welcome. I'm now creating a new strategy. And I think that's one of the common things that happen. People start out with the strategy. They say, if this happens, then I'm going to do this. But then it morphs into other strategies. And from my point of view, I want to be consistent. We set the strategy up. You and I have done our homework, so we're comfortable and confident with the technical approach we're going to use, when it works, how far it's going to move, all those parameters, before we ever do the trade. And then we just have to decide what option strategy we're going to use. And a bull vertical spread is an opportunity. So if our maximum profit is 50 cents, or I should say maximum profit is 35 cents, because I said that the difference in strikes was 50 cents and the net debit 15. So 35 cents. Depending on how this market's moving, at 34 cents, at 33 cents, I consider taking profit. Again, if that's what I'm trying to capture, for me to hold it beyond that, if I can get that 34 cents, let's say, out of the 35, for me to hold it beyond it, I'm not going to earn more. That's my cap. So once I approach that, I just soon say thank you to the market and put that in my pocket. Right, because that's a big deal for you and me. When do we say thank you? And again, I think that research that you and I could do could help us decide when this trade should work, how long it should last, and again, what our maximum profit is using this bull vertical call spread.
For sure, yeah. The example is extremely helpful, and it's tremendous insight on that, especially the numbers. You outlined, you can calculate the numbers, your risk profile is very defined, and Dan, you've also tied things together really nicely, going through the analysis, the strategy selection, and position management. To wrap up the comments and the description here today, what would you say you would offer as a final thought or closing comment in general about our discussion today for our audience?
Well, I would say this. It's important to understand the tools that you and I have available when it comes to options. As I said, they're a beautiful instrument, but it's important that we make them work for us in the best fashion. So whatever the strategy that you decide to use with the options, I think it's important to do some research to see how this has behaved in the past and what our expectation should be and when it should work. And technical approaches may be a tool that you and I could use to help us get those answers. But I think it's important, I think it's actually critical, that you and I do that homework before we ever implement the option strategy.
That's absolutely true. Couldn't agree more with that, tying those pieces all together. So great segment today. Thank you for sharing your expertise, insight, and background with the industry. That was Dan Gramza of Gramza Capital Management, and that was today's Strategy Spotlight.
It's time for a nostalgia break. It's time to take a look back.
From time to time, as the market moves, you will see different types of headlines hit the news wires. The yield curve is one of those topics that you'll see occasionally. And no matter what preferred method of investing you have or what products you use, a movement in the stock market, whether or not you're in the stock market, is still important, and the causes of those movements may help you decide where your other investments should be. So whether or not you're in stocks, movements in the market itself are important to understand. Government bonds and their yield can be one of these triggers in market movements. Let's outline how bonds work first from a price perspective and then shift into the yield curve itself. Bonds have a face value and offer a coupon payment. Investors who purchase a bond pay for it up front, and they are due the face value at maturity. In the interim, they are paid a coupon payment at regular intervals. Numbers will help. For example, if an investor pays $1,000 for a bond and the coupon payment associated with the bond is $50 per year, that's $50 earned off of a $1,000 investment every year, or 5% return. That 5% is considered the yield. Now, the government offers these bonds, but then they're traded on the secondary market. Demand and supply will then take over. If demand for this particular bond increases, then the price goes up. The price might go higher than $1,000. If it does, that means the yield drops because the coupon payment hasn't changed. If you then paid $1,100 or $1,200 or $1,500 and you're still earning $50 coupon payments, your yield will be less than 5%, and that's how those percentages change. You can also see here that there's an inverse relationship between the price of the bond and its given yield. So now I want to shift into the curve that I described earlier, and I'm going to take a little bit of a liberty to relate this to a topic in the options space, which is implied volatility. Many of you know that you can plot implied volatility on a graph, strike prices on the horizontal axis and implied volatility levels on a vertical axis. Just plot where they fall at each strike, connect the dots, and you have a volatility curve. You can do the same thing with bond yields, using the maturity dates on the horizontal axis, the yields on the vertical, and plot them drawing the curve. Normally, the curve is upward sloping, and that makes sense because investors who tie up capital for a longer period of time require a little bit more return on their money because there's risk tying up capital for a year or 2 or 10 years versus a shorter time frame, so they demand a little bit more. Now, here's a little bit of terminology that you might hear from economists or market analysts. A steep yield curve means that long-term maturities have a much higher rate of return than their short-term counterparts. A flat curve, or you may commonly hear a flattening of the yield curve, means that the difference between the maturities is tightening. And an inverted curve is when short-term yields are higher than long-term yields. This intuitively doesn't seem to be logical, and it is fairly rare. The idea or theory which follows is that bondholders have a weak near-term economic outlook, so they seek long-term security in the bonds that go out 2, 5, 10, or longer years in period. They want to hold their money in a safer asset to buffer themselves and weigh through the market potential downturn. As they go out further in time, the increased demand drives the price of the bonds higher. As I said earlier, there's an inverse relationship. That means the long-term maturities become depressed with their yields, and they could drop below short-term yields. That's what's known as inverting. Now, this normally doesn't happen across the entire curve. It's often noticed that inversions occur at a part of the curve or when comparing two particular maturity dates. I'll identify a few of them. The Federal Reserve is known to look at the 3-month versus the 10-year relationship as its preferred metric to evaluate market sentiment. In 2019, this relationship inverted in the spring, didn't get too many headlines. Another relationship that investors often look at is the 2-year versus the 10-year. These are two highly liquid bonds, and that's why they get a little bit more attention from the investment community. This relationship inverted in August of 2019 and caused a panic, brief sell-off in the markets. This is because historically, this particular inversion has preceded economic recessions. Now, while it has a strong track record, there's a few words to say of caution. There is certainly no indication on the length or the magnitude or severity of a potential recession just because an inversion is noticed. Also, the timing is difficult to interpret. Even when it has been a positive indication and recessions have followed, they've occurred anywhere between 6 and 18 months after the inversion occurred. A couple more things worth mentioning specific to 2019. One is with reference to quantitative easing by central banks. In this case, banks purchase government bonds as a policy, and that will drive down their long-term yields, and that potentially makes an analysis of the curve less reliable. Also, again, specifically for 2019, there are depressed bond yields all around the world, and this could be influencing foreign investors to look to the U.S. for long-term security in their investments, buying up long-term bonds, and again, furthering the possibility that the current yield curve is less reliable. As you might expect, there are different viewpoints, different schools of thought, and different ways of thinking about this particular subject. I want to highlight one thing as well. Everything I've mentioned here is with respect to the yield curve, its possible inversions, and the performance of the economy with respect to recessions. I didn't say anything about the performance of the stock market. That is a completely different story. So if you're evaluating your long and short positions and what you have in your portfolio, that's a different analysis altogether. Overall, while the yield curve has a history worth mentioning and being aware of, it is just one measure amongst many, and its accuracy of predicting future contractions in the economy remains to be seen. And that's today's Looking Back.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
The Options Clearing Corporation offers many tools on its website. One of them is the put-call ratio. The website is www.theocc.com, and this tool is under their market data section and volume area. This is a very simple calculation. It's put volume divided by call volume. That's it. Very simply, when the number equals 1, that means the number of puts and calls traded are equal to each other. If the number is greater than 1, it means more puts are being traded. If the number is less than 1, that means more calls are being traded. There's no more analysis than that. Now, how to interpret that number is a different story from one investor to the next. You may decide differently what extreme levels might be. Far above 1 means more puts are being traded, and that could indicate bearish sentiment in the market. Far below 1 means more calls are being traded, and that could indicate bullish sentiment in the market. Now, I mentioned that word, sentiment. That's not indicator. You would then, for yourself, have to decide if that bullish or bearish activity was a trend you wanted to jump on and continue with, or if you wanted to do a counter-trend trade. But those levels above and below 1 would be up for you to decide. All in all, this is a useful indicator to track as you evaluate what the market is telling you about future potential movements. Again, that's the OCC website, market data section, and volume. A well-known resource in the financial industry is Seeking Alpha, or seekingalpha.com. This source has financial news headlines and market quotes, but more prominently, it has experienced investors and industry experts contributing articles on the full gamut of asset classes. You can search by topic or follow your favorite contributors. The scope of these articles is very interesting and can range from analysis of market activity to offering some stock ideas and also dissecting an earnings report in great detail with mathematics and numbers. Keep in mind, they also have disclosures for anyone that writes articles. They will disclose if they have any positions in stocks and ticker symbols that they reference in their articles. It's a very good source because there's a strong element of education. Whether you're looking for ideas or simply education to learn about the markets, you can get an awful lot at Seeking Alpha. Some of you may be familiar with the name of Robert Shiller. He's one of the most famous economists in the U.S. today, and I selected one of his books as a good read. I'll start with a disclaimer that I selected this book because it has an interesting history and for entertainment purposes, not because it predicts the future or has any kind of foresight. Some of you, as I said, may know the name because he is a famous economist. You also may be familiar with the Standard & Poor's Case Shiller Home Price Index, which in part bears his name. Let's look at the timeline a little bit. This is what I find interesting. The first iteration of this book discussed the inflated prices associated with the dot-com period of the late 90s. The book was actually published the same exact month that the market corrected in the late 90s. Didn't give a whole lot of time for investors to read, absorb, and take action, but interesting how that was published on a concept that corrected at the exact same time. Then a second edition came out in 2005 covering the housing bubble. That preceded the bubble burst several years later. The housing crisis was a major contributor to the downturn in 2008, 2009. There's also a third edition came out in 2015 covering bond prices and then housing prices again. We'll see how this one turns out. Now, for those of you who know Robert Shiller by name, and you may know a little bit about him, he does tend to predict doom and gloom and recession situations quite often. Some critics might say that if you predict a crash every day, eventually you'll be right. So you have to take that in mind. Regardless, it's an interesting read, and the title is Irrational Exuberance by Robert Shiller. That's today's tools, resources, and good reads.
Not sure why your options positions are losing money? Let us point you in the right direction. It's time to ask, what's the risk?
I've got three very good questions to cover today. The first one from Trey: how do I make the decision on when to get out of bullish options positions? I can't be too specific with this answer, Trey, but I can give you some overview. When you have a position, and I'll take a further description on your question, that you have a positive position, it's moved in your favor, there's a couple of things to keep in mind, focusing on the how to make this decision. Just remember, you're managing a couple of things. First of all, it is your market outlook against the position you have. So after a move has occurred, possibly in your favor, just be honest with yourself and reevaluate the market. Ask if the bullish thesis is still intact, if you have some reservations, or maybe you're neutral or bearish. You have to make sure the resulting position is in line with your market outlook. And the second thing I'll mention is that you're also managing money. In addition to managing your market outlook, you're managing funds in an account. I found myself in a position many times where it was necessary to take money when it was available to me. This is similar to the concept of risk tolerance. Where do you stand currently with your portfolio balance? How are you performing on the year? You're managing those two things together, market outlook and analysis against your positions, and whether or not that answer still is true as consistent. You then have to back that up and think about your overall account and manage your positions appropriately. So those two things together, I think, can help you make that decision on when to exit positions. And thanks for the question. Number two comes from Husky Trader. Can you please explain the difference between historical realized and implied volatility? Which should I be concerned with when trading options? Well, Husky Trader, the first two of those three you mentioned, historical and realized, are the same thing. These refer to past movements in the stock, calculated deviations from the mean that can be used at different intervals. You select for yourself if you want to look at a historical or realized volatility, 30 days, 50 days, 90 days. You choose for yourself, but the point is it's calculated numbers in the past on movements that have already occurred in the stock price. And those two terms mean the same thing, historical and realized. Implied volatility is something different. One of the components to an options pricing model is volatility. It has to be in there, but of course the options are not trying to price the past movements of the stock. The options are trying to factor in future movements between today and the expiration date, and that's why the volatility level used to price an options contract is called implied. Now, your second question, what should I be concerned with, really is all of the above. You want to know what the stock has done in the past, compare that to current levels of implied volatility to see if implied is higher or lower. And then if it is higher or lower, ask yourself a question. Is there a good reason for that? Because past performance may not occur in the future. So you'll want to know, maybe this stock is due for some future volatility that is greater than has been seen in the past, or maybe not. You can use those two things together and make a trading decision. So implied volatility specific to options, historic also called realized specific to stocks. Question number 3 from Alan. I've often heard option selling strategies referred to as being short gamma. What exactly does that mean? And should it concern me with respect to additional risk to my covered call positions? Could talk for a long time on this question, Alan, but I really like it. Short gamma means that you have a position whose delta is going to change with an inverse relationship to movements in the stock. So as the stock moves up, your deltas go down and inverse. With respect to the covered call, you don't necessarily have to be concerned with it because your position itself is going to have long stock. Overall, even if the stock rallies and you become more negative on your overall deltas, it can't go to zero. So the risk profile on the covered call is a little bit different, and gamma doesn't come so much into play. Thank you for the question, Alan. Thank you all three, and we look forward to your future questions on industry happenings.
You've been listening to the Options Industry Council's Wide World of Options. If you have any questions about anything you've heard on today's show, email Ed Modla at options@theocc.com or visit www.optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at Options Education. And follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.